Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah, splitting the show into two, talking about the markets. Can't not talk about them today with the markets being at 25,000. Sanjay Parekh, founder and CIO at Soham Asset Managers, joins us right now on the show. Sanjay, great having you. Thanks for taking the time out and great day to have you. Congrats to every market participant on the Nifty hitting 25K, key milestone. Where do we go from here, Sanjay?
Yeah, Neeraj, good morning. Good morning to the viewers. 25,000 is an amazing feat. When you've seen the COVID lows at 17,500 and, the whole cycle over 25 years, it's a commendable achievement. And that is very, very clearly because all the balance sheets in India, I've never seen it so good. So right from the government balance sheet, where you see the operating leverage kicking in the recent budget, wherein, despite the spend that they had to do on rural and towards employment guarantee, and even shelling out to states, yet, the fiscal deficit was contained. And it's going to only get better. Then comes the RBI balance sheet, which is strongest ever. We have a lot of space there, unlike Fed, which is very tough for them to contract the balance sheet in a significant way. Then comes the current account balance situation, where again last quarter, fourth quarter, we had a current account surplus, which I have not heard for a long time. And that reduces the dependency on external flows. Household balance sheet, the wealth effect we all know is $1.5 trillion plus because of gold, real estate, equities. And the corporate balance sheet also at a leverage at an all-time low, and banking balance sheet, which is a fallout of corporate balance sheet being so good, again at the NPA levels, which are lowest ever. So in my career, at least, I've never ever seen all balance sheets fighting. And the best part is they're looking ahead also, they look great. And now we are able to see the benefit of wealth effect trickling down in terms of corporates doing capex, individuals buying assets, increasing the leverage to the level they can. And that is self-fulfilling and virtuous. And that is also reflected in real estate stocks doing well. So the whole cycle of wealth effect percolating in terms of further increasing growth is what I think is the longer term positives. And as you know, Neeraj, in the near term, valuation is one thing which we are all grappling. And that is certainly not as comfortable in terms of stock entry levels that we want to.
So Sanjay, then therefore, are you taking a cash call at because of the valuations, or are you looking at the momentum in the story? Because frankly, everybody's gotten proven wrong, right? Every person who's taken a cash call has gotten proven wrong, because I think somebody mentioned this yesterday. He was not so constructive 3,000 points ago and mentioned that people have underestimated the impact of the flows from the domestic side.
So right. So at least, our end, and that is reflected in our cash levels every month. Our cash levels have been ranging in 6 to 8%. We very strongly believe that this is not a zone where you need to take big cash calls, at least in the institutional format, where the allocation is done to you, the allocation is done by your investors, and then you further need not take big allocation calls. And we've stated in our PPM as well that if there's an extreme froth, we will go to 15%. But we don't think that we are in an extreme froth zone, at least in the larger cap space. And we are predominantly, our average large cap holding has been 80%. Right now, it is 76%. So we think that this is not a zone to create big cash. But what the approach is that, cash will not hurt, is how we think about it. And then there are individual Neeraj, a lot of opportunities. So when you look, it's just the filtering that you do has to be really hard this time. So when you're buying or looking at new stocks, you really have to see that there is price value gap. And if you get even irrespective of the level, I think you can add. And that's our approach is that look for those businesses at any price level where there is a price value gap. And maybe in 10 stocks you look, 9 of them you'll reject because of valuation. But at least you'll get that one stock. And we do get them, even today, where we think that it is worth participating. But the margin of safety, and you can't get into the momentum of overpaying for growth, is what we are very conscious.
Sanjay, I have a question though out here, a bit of a contra question, right? There are businesses which, if you compare to the 10-year averages, right, will definitely look expensive because the whole setup of that sector has changed, right?
So,
Power
right.
equipment, defense, etc. How do you take a call, let's say, for example, on defense? The stocks are expensive. If you look at TTM valuations, they look egregious. When you look at 3-year out valuations, they look very strong. We were talking to one company day before yesterday who said that we'll grow 100% in FY25 and go 50% for the next 5 years. Now, my question is, how do you value something like this?
Yeah, so let's see, I'll tell you, we are hardcore GARP investors. And here comes the philosophy and following to the hilt and not getting carried away with the momentum. Our price earning of a folio is 16 times on 26, where markets are at 20 times if we take 1250 rupees earnings on 26. So the key is to get growth at a reasonable price and keep that discipline. So we are very clear if there, something what you call as defense. We then tried, and the benchmark also, we look at 26 and 27 in certain cases, having known that visibility for 27 is less. So 25, 26 are the immediate goalposts, and then have a reasonable view on 27. But if certain stocks at 28 would come down to price earning at lower levels because growth are going to be great, one has to be careful because some of the stocks do have lopsided growth as well. Yes, some of these, defense and all have done very, very well. And yes, we've not participated. And we have to admit and introspect whether you could have got them right earlier. But to buy and chase them at 60, 70, 80 times is at least not our strategy is. And it's okay to miss out, God's grace, our performance has been good, very, very good, with 32% alpha in 2 years. So we are okay. We'll just wait for the right stock and look for stocks which we think are right. Don't have to participate all across.
So is defense not a part of the portfolio, Sanjay?
So we have, of course, Aussie plays like Larsen & Toubro, which is a very large weight. Earlier we had, so pure defense play, we have one company which has a small element of defense, which once it's carved out, but that's a very small part of the value today. But direct defense play today we don't have.
Okay, you don't. Okay. The other aspect is, Sanjay, the slight here and now, and I'm trying to think about autos because of what the companies are reporting, right? Mahindra & Mahindra, I was just talking to them before you came in, and they spoke about how there might be a tractor upcycle in the offing if the monsoons stay okay. But contrary to what the note suggested today, they seem very confident about autos. Maruti's upped the margin game quite significantly in the quarterly numbers gone by as well. But it's a sector that has had 4 years of very strong performance. Is there more in store? And if you are invested in autos, what within autos? 4-wheelers, 2-wheelers, auto ancillaries, batteries, what do you like?
Yeah, so here is where we are right now neutral. So we have Mahindra, luckily we got it really early. And this is a stock which we were tracking right from Anisha joining. And that was in my earlier avatar. And you could see the changes he's doing step by step with a very clear articulation of strategy. And then what was missing was the product pipeline and the product, the overall of the product. If you see products of M&M 6 years back and today, and auto was one weak area, few years back, which they have significantly improved. And I still remember, I will tell them that I don't think any drawing board where a car purchase has to be done, you will figure out. And you see the change today that, even young aspirants would certainly look towards M&M vehicles, and they've really done a very good job. And then the whole change on capital allocation, not allocating capital to wrong businesses, a very clear articulation of strategy. And even today, the valuations are quite reasonable. They're not overbearing. So that is what we like. Overall, auto EV as a consumer play, we clearly like them. So we have Motherson Sumi, Samvardhan Motherson, now held for 1.5 years. We have Sansera as one of the stock, which have now, it's again significantly in the money for us. And then, of course, we have Ashok Leyland as well. which we bought in around 1 year back. So, and then Maruti also, we don't own it, but it's just the right entry price, and we would want to enter at the right price. We are positive on them, but at the right entry point.
Got it. Okay. Now, thanks for those insightful answer, of course, Sanjay. One more aspect is this uptick that tactical investors slash traders are now taking a bet on, which is on commodities. If the Fed is going to cut rates, could commodities come back? Of course, a lot of it would depend on China too. But oil certainly is revved up a little bit and has brought at least the upstream oil companies in focus too. Where are you on this commodity stock investments, if at all?
Right. So, we've disclosed this. So I'll tell you, we used to own Hindalco and we entered Vedanta at a much lower price. And again, 40% up for us. But we did book profits in Hindalco. And I mean, it's a great company, just that we thought valuation is in the near term upside is limited. Vedanta we still own because I think the overall deleveraging by the parent will certainly help them. And they've got an approval for demerger of all the 6 companies. And when we have seen that when there is a focus of each of the companies, there is clear value creation. We've experienced even in our other portfolio companies where they've gone through split and it has significantly created value. And the best part here is the parent is also delivering, which was the biggest concern by the Indian shareholders. So here is, but overall on the ferrous space, I think, the valuations are not cheap. In one of the players, you have global exposure in Tisco, which is still going to struggle for a while. And the domestic piece is certainly good. And in the other player, of course, a pure play domestic, but even they have some global exposure, which is not contributing, which is JSW Steel. So JSW Steel, of course, is a great company and absolutely impeccable on execution. It's just that we think near-term numbers in terms of EBITDA per ton don't justify the upside from our valuation standpoint. But just one point that yesterday, in the Tisco's notes, there is one Supreme Court judgment which we are also closely reviewing, whether it gives an entitlement for the states to levy more taxes in terms of royalties. That is, I think, we need to closely, whether it's going to be retrospective or prospective. And that is one area of concern where if it were to give more rights for the states to levy, we certainly have to see what lies ahead. So this is
Sanjay,
Sanjay,
sorry, we need to wrap, but I'm intrigued, just wondering, do you reckon, very quickly, do you reckon this could open up the whole metal space for such levies? Are all companies vulnerable there?
Yeah, we have to watch it because it's a very clearly written in the notes, and it could be anything which is under the MMDR Act. The Supreme Court has said that it gives them a right, the states a right to put levies. Now, as I said, we are also closely seeing what's the legal view here. But apparently, it does seem that we certainly have to dig more and think about what are the potential risks in the metal space.
Sanjay, so good talking to you. Thanks for breaking it down so well for us on so many aspects. Really appreciate your time this morning.
My pleasure, Jigar. Always. Thank you.
That's the view from Sohum Asset Managers. Time for a break. We didn't get a chance to ask Sanjay about Mahanagar Gas, but what we'll do is we'll ask the company about how the quarter went by and more importantly, what's the outlook going ahead. Remember, they posted numbers wherein the margins expanded a little bit, about 130 basis points, if you will. We get the management on the other side of this very quick break. Stay tuned.